Good morning. This is Dave Toth with an RJO MRT Technical Webcast update on the US dollar index, the euro currency, the gold and silver markets for Wednesday, November 30th. Starting off here with an intraday chart of the US dollar index, you can see just over the course of the past half hour or so, the market's sharp break below yesterday's 78.52 low that confirms at least the short to intermediate term trend is down and defines today's 79.38 high as the level this market, the short-term level this market now needs to recover above to render this sell-off attempt another three-wave and thus corrective sequence within the broader developing bull trend that arguably remains intact from a longer-term perspective dating back from that October 27th low. We've had a lot of activity just over the past half hour or so in a number of the markets as a result of the central bank coordination of lowering swap rates that will help provide more liquidity to the banking system and perhaps help both the Eurozone and U.S. economies to perform a bit better. We've seen a significant bid to the U.S. Stock indices and the global indices indeed, and we'll discuss those in blogs and webcasts later or throughout the morning. But as a result of this morning's break below 78.52 in the U.S. dollar index, shorter-term traders with tighter risk profiles are advised to move to a neutral sideline position with strength above 79.38 now required to resurrect the broader bull trend. From a longer term perspective, however, looking at the daily chart of the US dollar index here and the extent of the market's recovery from that October 27th low at 74.72, and while admittedly the market's recent position or proximity to the extreme upper recesses of the past couple of months range exposes a precarious position, and despite the excitement of the past hour's sell-off, this setback is thus far insufficient to break the larger degree bull trend. In this regard, we need the market to prove strength below specifically the November 18th low at 77.53 and an area of former resistance, new support, really to break this broader bull trend and expose a much larger degree correction or reversal lower. From this longer term perspective, then, the past couple of days break, including this morning's, is advised to first be approached as a corrective setback ahead of a broader developing bull trend. As indeed, looking here at a weekly log close only chart, you can see last Friday 79.61 a high close, confirming a new high close for this year's broader reversal higher. So in this longer term regard, longer-term traders remain advised to maintain a bullish policy with weakness still below the 77.53 low required to take similar defensive action. Similarly, looking at an intraday 4-hourly chart of the euro currency, you can see this morning's recovery above yesterday's 134.43 high that confirms at least the short to intermediate term trend as up. And in this regard, shorter term traders with tighter risk profiles have been advised to move to a neutral sideline position with weakness now below overnight's low at 132.58. required to render this recovery attempt another three-wave and thus corrective sequence like we've seen most of this month within a broader developing bear trend. Moving to a daily chart, you can see the market's recent proximity to the lower recesses of the past couple of months range that always have to be watched for at least an interim corrective hiccup, if not a broader reversal higher. But again, given the extent of the past month's decline in the euro currency, strength above the November 18th high at 136.15, we believe is required to break this broader bear trend and expose a much larger degree correction or reversal higher. Until or unless such strength above 136.15 is proven, longer term traders are advised to first approach the past few days recovery attempt as another bear market corrective sequence ahead of a resumption of this bear trend to what could be significant new lows below that 131.46 low from October 4th. Moving to the gold market on an intraday 4-hourly chart, you can see this morning's sharp continuation of the recovery that began with the earlier this week with the market's recovery above that initial resistance between 1713 and 1705. That, since broken, has generally held as new support, and by verification of this morning's continued strength as a result of the news of the central bank action on reducing swap rates. The market, we believe, has defined today's 1704 spot 30 low as the latest corrective low and tightest risk parameter, this market is now required to fail below to arrest this recovery, expose it as a three-wave and thus corrective sequence ahead of a larger degree consolidation or correction lower. While the market remains above 1704 spot 30, further and possibly accelerated gains should not surprise. But even with that prospect, traders are advised to only maintain a neutral to cautiously bullish policy. For looking here at a daily log scale close only chart, you can see the market's position smack in the middle of the middle half of the past 4 months broader trading range between 1892 and 1595. In which aimless whipsaw risk continues to be our biggest challenge. Despite today's clear continuation of the past week's base and reversal threat from a short to intermediate term perspective, from a longer term perspective, and given the market's position in the middle half of this broader range, traders are advised to maintain a neutral sidelines position as longer term directional expectations have to be kept low. The risk reward ratio of initiating directional exposure from a longer term perspective from such middle range environments is typically poor, and we don't advise traders to longer term traders to make a longer term directional bet. But again, from a short to intermediate term perspective, clearly the market has provided some strength that warns of further and possibly accelerated gains until or unless the market weakens below today's 1704 spot 30. Finally, moving through the 4-hourly chart of the December silver contract, you can see the market's current recovery. Within the past couple of weeks lateral range that we continue to advise traders to first approach as a bear market corrective or consolidation pattern with strength above last week's 3304 high required to mitigate that neutral to cautiously bearish threat and expose a larger degree reversal higher. You can see that that high represents an area of former support, new resistance, and the 50% retracement of the 35.35 to 30.65 decline, cutting across at $33 even. While last week's 33.04 resistant cap remains intact, so does the prospect that the intermediate to longer term trend is down. Strength above 33.04 is required to negate that and expose a larger degree move higher. Please stay tuned to updates on these and other markets on our rjomrt.com website, and good luck with today's trading.